Hello friends, in the earlier video we have discussed something on capital markets first and then on capital market instruments. Let us further move now into the equity markets. Now equity markets are generally popular because most of the investors are keen to invest in equity markets. Why they are very keen? Because there is a craze. Why not we will make money normally by trading in the companies, trading in those companies where normally there is huge flow of funds, huge flow of cash, trading in those companies where there is a lot of profit which can be expected. So in such case, see, making money is not a crime, and making money in the right path definitely is possible when we invest normally in capital markets. So capital markets normally generally consist of equity markets, and equity markets consist of generally buying and selling of equity shares. So now let us see what is the mechanism behind this in terms of the trading and settlement now. So how to buy and how to sell a share, because for everything there is a procedure and process. So let us understand how this procedure and process works. First of all, from the viewpoint of buying the shares, and then let us look at now the selling of the shares. So when you look at now the buying of the shares, now the following things are possible. The mechanism is like this. First of all, now let us see this one. First of all, before we move to the mechanics of buying, now let me tell you, the trade can be made in two ways. One is offline, second one is online. In the case of offline, what we do is normally we give the instruction normally to the broker or whoever normally we have got a demat account. So the person should have his DPID number, Depository Participant Identification Number, and the person should also be registered with normally the stock exchange. He must work for the registered stock exchange. For example, Geojit is a broker now, India Bulls is also a broker, and then Sharekhan is also a broker, RV Finapolis is also a broker. Like that, normally these are registered brokers. With the help of registered brokers, we trade in the case of offline markets. Second one is online markets, where we directly trade into the stocks without the help of the broker. It is done through internet itself by having our own ID and password. So the user ID and password will be given to us, which we can use in the process of trade. This one side. Now let us look at now the mechanics of buying of the stocks. The steps for buying a stock. The general step for buying of the stock is like this. First, now again we should open a demat account. What is this demat account? First of all, the demat account is normally called as dematerialization account. Dematerialization means converting the physical shares into electronic form by the means of internet. Converting physical shares, that is in the form of paper, into electronic form. So what happens there is, shares get transferred in your name itself. Number of shares whatever you have, that will not come down. Number of shares whatever you have, normally you will get the ownership of that. It will be transferred automatically in your name itself. Okay, so in such case, normally the first procedure is opening a demat account. Demat account. So demat account generally is dematerialized form. Okay, so that is one side. And then after you open a demat account, generally the procedure for opening a demat account is you have to complete your KYC documents, finish your KYC, and normally after 10 to 15 days, account will be opened and activated to you. Once the account is activated, then ultimately what you should do is normally, so the most important thing is, see, if you want to buy, you give an instruction to your broker with the complete details. So instruction when you give to the broker, normally you should know the details like which company stock to purchase and in what quantities. For example, if I want to purchase say 10 shares of MRF Limited, I should mention that I want to purchase 10 quantities. Today's price in the market, that is one side. And then normally when you give the instruction to the broker, it should be very clear what price normally I want to buy, whether to buy immediately or whether to buy after half an hour or whether to buy at a particular price itself. So you have to place an order there. So when you place an order, normally there are three types of order. For your knowledge, let me tell you very clearly. First order is called as limit order, where you place your limits, saying that for example, again, if the share is costing 10,000 rupees, if normally 10,100 comes, I will buy. That is my limit order. So you place a limit for the price, that is there. So this one thing which can happen in the case of limit order. Okay. The second type of order what you place is normally called as stop loss order. Suppose if you find that normally there is a possible loss which is going to happen, now you give an order, place an order before a broker saying that if so much amount comes, normally leave my stock, so that normally there is no further losses possible, just to stop further losses. That is called as stop loss order. Third one is called as execution order. The execution order is normally for just executing the trade. So like normally so much share has to be transferred once you place the order. So that is normally one thing which you have to take into consideration. Limit order, execution order, and stop loss order, one part. So you should give the complete details of what stock to purchase with the broker. Once the details is given, broker undertakes the order. So from you will take the order and normally again he will again make sure that the order is executed by making sure that the respective number of shares is transferred into an account. So how this works is, when he places the order, ultimately so from your account normally is whatever normally the price is there for say 10 shares or 20 shares, that will be debited, and then ultimately what happens is shares will be credited. Generally it is a 3-in-1 account, where normally savings account, trading account and demat accounts are interlinked. Savings account, where you should have money, normally again from there normally when you place an order, normally again so much amount will be debited, whatever is the price of the stock. And then a trading account is for the purpose of trading itself, that is buying and selling of the shares. Demat account is normally to keep your shares in the account in the electronic form. So ultimately the investor will get to know basically how much shares has been credited, because contract note he will be receiving in electronic form as well as normally in the form of statement physically as per the instructions. This is there. So this is the answer. This is given normally in step number 3, that is broker undertaking an order. Next, fourth step is, after broker undertaking an order, now again the most important thing is the respective stock or the share is credited to the buyer's account and the amount is debited from the savings account, which means that the buy process is completed. Okay, so in short, now let me tell you very clearly to make you understand better. First, open a demat account. Once the demat account is opened, now again we find that your so the respective account number, everything is generated. Once it is generated, give an instruction to your broker with the complete details. What stock, in which quantities you have to buy. Second step. Third step is, now again the broker takes the order and normally he executes the order. Once he executes the order, ultimately what happens again, the order will be processed further and the respective stocks is credited to your account, and then amount whatever is to be debited, that will be debited back to the respective account. So this is possible here. So this is one step for buying. Next mechanism is selling. Okay, suppose if you are already purchased a stock, or some stock is there in your portfolio, and normally you find that normally the respective stock price is not reaching to your expected levels, or the case may be like this also, where your expected price is reached. So in that step, what you normally do is, you decide to sell a particular security. Now earlier I have purchased 200 shares, now I don't want 200, I will sell 100 out of that 200. So 100 shares when you want to sell, ultimately what you should do is follow these steps. First step is normally give instruction to the broker as you have given earlier. In this, what you do is normally you give an instruction specifically in the contract note to sell that particular securities. Sell instruction will be given. Once sell instruction is given, now again what is important is, now again if you are going for offline, you have to sign a contract note. The contract note will be filled just like normally the bank challan is filled. The contract note will be filled by the broker and given to you. You have to see that now again whether your instruction is there in that, then sign the contract note. On signing the contract note, broker has got the right to process the order, because your request already has been placed. Based on your request, that order will be again placed by the broker and then process that particular order. Broker's main job is to process the order, make sure that normally so much stock is sold at the price whichever is ruling in the market at that time. So in the ruling price, the stocks will be sold. Once the stock is sold, ultimately what happens is, as per your instruction, the process will be completed. Upon successful completion of the process, what happens is the stocks will be debited from the account ultimately, and whatever is the amount whichever is there for that price at that time, whenever you are making a sale, that much amount will be credited to your account. That is it. So that completes the sell process. So mainly the mechanism of this trading in shares consists of buying and selling. So buying is having a particular process, sequentially you have to follow that. Selling also has got a particular process, sequentially you have to follow that particular selling process. So this is how it has to be understood in normally the respective financial market. Buying of securities and selling of securities, both can be done online as well as offline. Online means normally we have to do it ourselves, so without the help of broker. Offline normally is possible normally with the help of the respective registered brokers. So what I recommend to you is, suppose if you are having that particular knowledge of the market, and second thing is, now again you know very clearly how the market is working, and more importantly when you have got the time to spend in the market, go for online. If you don't have time to spend in the market, suppose if you are employed somewhere, if you are busy with your schedule, and then if you are very busy with your work timings, then you cannot spend time with the market. So in such case, best thing is normally to instruct the brokers, operate through brokers, and make sure that normally you get a better broker, and normally your trade and trade of normally buying and selling of the stock is carried on smoothly. So this is how it has to go. Thank you very much.